In this video, guys, we're going to look at 4 ways to choose a scalper's stop loss. Stay tuned. Hey traders, a very warm welcome to you. So this video comes from a question, and I'll talk about who it came from in a second and what they asked, but it follows on from a scalping kind of mini course, if you like. We did a few videos talking about scalping strategies, etc. on this channel. It was on YouTube, those little bits and pieces talked about scalping. Some of you enjoyed it, some of you found it very, very useful. Thank you for support on that. One of those people was Amit Sinha, sorry if I butchered your name, but they said, what's the trick for stop loss selection in scalping? I find it very difficult to decide at times. And Amit, I feel your pain because it is very, very tricky to get a stop loss together when scalping. So I've kind of want to simplify this and give you an idea on how you can do it. So 4 methods when you're scalping, how you should use stop loss. The issue we have with scalping is that if we get our stop loss wrong, it negates and undoes lots of good work we've done, right? It's like, okay, I had a stop loss here, I scalped this out, then all of a sudden, bang, I get smacked. You've undone 10 trades worth of good work, 5 trades worth of good work, whatever it is. So that's always going to be the challenge, but how can we kind of reduce that a little bit? 4 ways of doing it. Number 1 is the ATR, number 2 is the largest, talk about this in a second, 3 is fixed, 4 is chart. Let's start with the first one first. ATR is average true range. So imagine this imaginary chart here that we're looking at, and say we're on a 1 minute chart. You could be on a smaller time frame, like 100 tick if you're using a tick chart, 30-second chart or something, whatever, it doesn't matter. But 1 minute works for me. I quite like a 1 minute, it's suitable. So ATR, you're going to have, as we know, it's average true range. It's going to oscillate up and down, depending on what's going on. It might increase, it might go down. You get the idea. If you're familiar with ATR, if you're not, go just chuck it up on a chart and have a little look. Set it to a 10 period. I play around with that, but that's a good starting point. And use that as a stop loss. That might come out at something like, 8 ticks. It might come out like 6 ticks or something. So you can use that and say, well, that's the average true range of a 1 minute bar over a 10-minute period or whatever minute you've got, and it's about this. So if I use that as a ballpark, I know that if my scalping's right and I'm looking for like that extension, which is going to be a little bit more perhaps than the average bar, then I'm not too far off. I might not be 2-to-1 risk reward ratio, I might not be 3-to-1, but I might be okay. All right, so once we've done that and you've got your ATR and you've decided, all right, so it's going to be 8 ticks or whatever, you can then just use that as a fixed thing, and it just adjusts as the ATR adjusts. It starts getting more volatile, that will go up. The good thing about that is it increases and decreases with the volatility of the current conditions. Now you might get caught out from time to time because you're only using 10 minutes. Obviously, if it goes stagnant for kind of midday or something, you're scalping that, and then it suddenly starts kicking off in the afternoon, you're going to be in trouble. But as long as you're aware, as I mentioned before, of your main times, like your economic data, your opening hours of the US session, European session, Asian session, stuff that's going to potentially be a catalyst for extreme move, then that's okay. So ATR is 1, and that's a good one. Second one is largest. So this is taking the largest candle of a session or of an hour or 2 hours and using that as a stop loss. So if we're trading now, we'd look at this one here and we'd say, right, that's the largest candle. Let's say that's 11 ticks. That's our stop loss. Now, some people, that's a bit too much for scalping, and I get that, right? So what you can do is you can say that's your emergency stop, but I'm going to trade it based on my view of the market. So you're scalping it, you're long, you're out. You're long, it's not working, you're out, and you're very, very active. But your primary kind of fail safe, if you like, is this, because if it goes more than the largest candle, you're just completely wrong as a scalper and you want to be out. Now, yes, that might be too large in some aspects, but it's a safety net. The whole point is, guys, is that is a safety net that you can work off. Okay, so we've got the ATR, we've got the largest candle. The second or third one, sorry, is fixed. This is generally a really good one because you can align yourself with how you trade. So you can say to yourself, right, I'm always going to use a 6 tick stop loss because my spread is 0.5. I'm always looking for 10 ticks to 12 ticks. And if I looked at my history and the way I've traded, then I'm quite good at the entry. It might go against me a few ticks, but generally 6 ticks I'm normally good. And so you can align yourself with your trading style, your trading acumen, whether you're great at spotting it, maybe a bit early, a bit late, whatever that may be. You can align yourself with the market conditions and you can choose a fixed stop. So what's the ATR of the day? Right, well the ATR is 50, then maybe you don't need that much of a stop. Maybe you need less than that. But then of course if the spread is quite wide, then you've got to be careful of that as well. So look at the range of the day, look at the spread of the market you're trading, look at the conditions you're trading, and then if you have got the data, look at the data for how you perform. Are you quite good at getting the entries? Are you quite good at getting the initial pulse? When you're wrong, are you very, very wrong, or are you a little bit wrong? And adapting it for that. So that's your fixed, guys. And the final thing is chart. So chart is, I think we're moving away from scalping more into day trading here, but I want to talk about it nevertheless. So chart would be, all right, okay, you're deciding you're going to go short on this little pop-up here. Not an unusual trade setup. That's pretty good actually. You know, you're coming down, you're flagging it loads, you're popping up, bit of a range break fake type setup there. Not so good with prior price action because you've got the open here, but you know, I've just kind of thrown this up here, but you get the idea. So you might say, well, okay, I'm taking this short now on the open of this bar. So my chart position would be a classical stop above the high. Now, many of you will say, well, that's just day trading stuff. It is, but if you're super early with your trade, i.e. you're trying to trade short, let's say, okay, let's say we kind of zoomed in on this and we had this, right? That's pretty much what it is, right? And let's say you were trying to align yourself with the short side, okay, which would make pretty good sense. So you might be hitting it short with a stop above here. So you might have got pinged out by a few ticks. You might take a few tick loss, and it kind of goes your way, and then maybe you've scaled out, then you got pinged out. You're working around a core position. Scalping to me is generally kind of being very active around a core position, looking to get the biggest position you can when the move goes and then taking it out. So you'd be shorting this, maybe get stopped a little bit, take off half, add half on, play around with it. You'd probably get stopped out as it popped up here, and then you're waiting to see how far it goes. Then when it starts to roll back in, then you're like, okay, well, I'm shorting it now. And then as the momentum starts picking up, you might well be adding to the position as it rolls through, looking for a final flush through that low. Okay, so your chart-based stop is, well, if it comes out above this high that's just printed after this candle amount, when you were trading it in this area, the chart-based stop was going to be above those highs there. So you're adjusting it to suit the little nuances and conditions. And then as you're scaling in here, as it's pushing lower, you're not adding any more short as it breaks through the low. You're probably scaling out the long and feeding it into those stops as you push through that lows in that scenario there. And so it's a different kind of way. But if, let's say, for example, you'd done that and it started to pop up, you'd use a chart-based stop and say, well, it's popping back up. I need to take some of this risk off because I don't want to have that full boat on and it just rip up away from me. So you might say, okay, take a little loser, you still got some winners, then it rolls over, and that's going to happen. So it's more based around what's happening on the chart on a very minute time frame as opposed to anything else. Which is the best? You know, it depends on what you want to do. I like to kind of use a little bit of a hybrid. So using a fixed or a largest as a kind of worst case scenario, and then being a little bit more aggressive, perhaps allowing my judgment to take charge a little bit more, and using a chart based or a pattern based or a price action based entry and exit criteria when I'm scalping. Hope this helped, guys. See you next one. Take care. Bye bye.